And also the fact that you had such a crescendo of concern about this trade war building up into the moment of July 6th when we had finally something on the books in terms of the U.S. and China tariffs. So I do think the setup, people got very defensive over the last week or 3 or 4 weeks, actually, buying bonds, buying the defensive groups. And I think that allowed for some tension release the last 2 days. We are, though, the S&P 500 gained strength through the day. We didn't have one of these late day sell-offs that we've had for a while. It was the aggressive groups that were leading. But I will say the index just got back up to the level, almost to the tick of where it was in mid-June for the highs, which is a little bit below the March highs. So a good day, a good trend. I still think it has something to prove in terms of getting back toward the old highs in January, though.
And Sandy, I know you like some interesting names like Rio Tinto, which we don't talk about enough, Verizon as well. But the overall market here, have you been taking advantage of some of the weak days around the trade fears to load up?
Well, you know where we've noticed some opportunity being created by the weaker markets is in the convertible bond market. We buy convertible bonds as part of our equity income strategy. And with the weakness that we've seen lately, it's really allowed us to buy bonds that would ordinarily be too expensive. And so it offers nice downside protection, which we're always looking for in the fund. And then we have good yield to maturity or yield to put. So it's an excellent strategy for us, and that's what the market's allowed us.
Charlie, are you buying more of the outperforming banks and industrials today? Is that the start of a significant rally in those recently underperforming sectors?
No, I wouldn't say so much. I think people are anticipating a good earnings season for the banks, but they've been a soft sector for a while. If you look at a portfolio of regional and even New York banks, they're down 5, 6, 7% this year, and they got ahead of themselves early this year where it was a crowded trade to buy banks. So the answer is no. In industrials, it's very much a case-by-case basis. There's some wonderful auto parts suppliers like Borg-Warner who've been beaten up over trade fears. But then there's some other industrials that frankly look pretty expensive. So I'll say there are big opportunities in some industrials, not so much in banks.
Yeah, I mean, we're seeing some real strength, actually. The S&P looks like closing near its highest level since June. We're back breaching technical levels. Mike, how much of this has to do with anticipation of earnings, where we haven't really been focused in the last few weeks?
I think earnings have been kind of the one thing you didn't have to worry about this year. So I think the refocus on earnings and the fact that estimates have held up going into the reporting season, almost everybody expects that typical 70% of companies to beat earnings. Now, the question is how much is reflected in stock prices already. I think we'll get the typical, some conspicuous sell in the news reactions, but on balance, it's going to create support for the market as it did in the first quarter.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.